Hi, everybody, it's AJ speaking. This is a financial review of NIO's second quarter results, which dropped in the last 3 hours. Stock is currently quite volatile, bouncing up and down by several percentage points, and was briefly down over 10% right in the first few minutes after results were released. So let's see what's going on. So revenue was up year over year 9% to $2.654 billion. The primary driver was actually not vehicle sales, it was the other segment in which NIO books all the service revenue related to its fleet, but also paid charging sessions or swapping sessions and everything else that is not related to new vehicle sales. That segment was significantly up year over year to 401 million or 63%, and the auto segment, the main segment, was up only 2.9% to $2.25 billion. So that gives you already a clue what's going on. I'd like you to keep in mind the auto segment year-on-year growth rate of 2.9% because that is important later. Next, let's look at deliveries. This chart shows you monthly deliveries as of latest data available. This is for July and August. But for the second quarter review, the sales that are relevant for the financial is only the sales that you see in April, May, and June. And in that quarter, NIO delivered 72,000 vehicles, and these sales were up 26%. But you just saw that sales were up only 2.9%, even though volume was up 26%. This gives you another important clue as to what is going on. So please keep these numbers in mind. Revenue up 2.9%, volume up 26%. Then let's look at gross margins. So this chart shows you all the relevant gross margins that we can calculate from NIO's disclosure. This is one total gross margin which reflects everything. That margin came in at 10.0%. And that is a modest improvement compared to last year. And it's always good to compare the respective quarters year over year and not sequentially, because in the auto industry there's quite significant seasonality, especially for Chinese automakers. So the relevant comparison is the 9.7% of last year. So we can see that on a total basis, there was a rather, let's call it, modest improvement of just 30 basis points. 30 basis points is 0.3% points. So now keep in mind, revenue was up 2.9%, sales were up 26%, and margin only improved by 30 basis points. And when you look closely, vehicle sales margin, gross margin on vehicle sales, that's the blue line, that actually decreased. It went down from 12.2% to 10.3%. So the offset was really coming from the other sales segment. That improved quite substantially year over year from negative 12.3% gross margin to 8.2%. So not vehicle sales was the highlight of NIO's second quarter result. It was really the other sales segment. And we need to keep track on what's happening. So when you focus on the auto segment, the main segment of NIO, revenue up 2.9%, volume up 26%, and margin decreased year over year to 10.3%. The reason why I keep repeating these important numbers is because they become very important later. But let's move on. This chart shows you the gross profit. Gross profit was up 12% year over year to 265 million. But if you look closely, what was driving this was the substantial improvement in other sales and not auto. Auto gross profit actually went down, decreased from 266 million in the second quarter of 2024 to only 232 million in the second quarter of 2025. And keep in mind, this was despite 2.9% revenue increase and 26% volume increase. So the volume and revenue increase could not offset the loss in gross margin. And next we need to look at operating expenses. Operating expenses decreased 1% year over year to 950 million. The decrease was entirely driven by a reduction in an R&D spend. NIO reduced R&D spending by 6.6% year over year, or 30 million in the second quarter. Down to 420 million. And that's the lowest spend since the first quarter of 2024. On the other hand, NIO ramped up significantly its selling efforts, since SG&A spend increased 5.5% year over year. And SG&A is predominantly driven by selling expense. That's the S in SG&A. Then when we look at operating expenses on a relative basis, we can look at efficiency ratios. This is what you see on this slide. The green line is R&D expense as percent of total revenue, and you can see that NIO has never spent less on R&D relative to revenue, while NIO maintained its level of SG&A spend relative to revenue. NIO spent 20.9% of revenue on SG&A and spent 15.8% on R&D. And then when we look down here, so for the first half, NIO spent 35.5% of total revenue on total R&D and SG&A spend, or OPEX. So then we look at operating profit. Operating profit was not a profit, was operating loss. NIO has never generated an operating profit, and this operating loss came in at 685 million in the second quarter. This is a slight year-over-year decrease from 727 million. But the one of the all-time highest losses was generated in the first quarter, and that leaves the total first half of 2025 loss up 6.8% year-over-year, i.e. Losses increased year-over-year to 1.6 billion in the first half. So this is already telling you quite a lot what's going on about NIO. So just to recap, revenue up, volume significantly up, gross margin slight improvement, but not meaningful movement in losses. Then when we look at operating losses on a relative basis in terms of revenue, you can see that NIO's negative operating margin improved only a tiny bit. So last in the second quarter, the margin was negative 29.9% and came down to 25.8% now negative. Next, let's look at non-operating items. Non-operating items comprise the financial result, which comprises the net income or net interest expense and other gains or losses. NIO used to have some healthy interest income in that line item, but NIO has significantly depleted its cash reserves, and for that reason, the net interest income significantly reduced. In the second quarter, net interest income was only 15 million, and that is down from 51 million last year. And since interest income became so small now, it's insufficient to offset other line items that are a part of non-operating items, such as interest expenses, which came in at negative 30 million. So the net result of all of that is that pre-tax income came in at a pre-tax loss of 691 million, and that is a very modest improvement year-over-year of just 1.8% loss reduction from a loss last year of 704 million. And pre-tax loss for the first half is even up 14.4%. And that leaves the profit margin still deeply in the negative at a negative 26.1%. And that compares to 28.9% negative last year. Now we look at tax expenses. They are de minimis in NIO's case due to lack of profitability. So we can move right on. Shareholders' losses actually increased in the second quarter year-over-year by 0.3%, so broadly flat to 718 million from 716 million. And to avoid any kind of currency effects from currency conversion, I use constant FX rates. So this increase in shareholder loss is consistent with the numbers disclosed by NIO in Chinese yuan. And in this red box on the right-hand side, you see some of the key insights from NIO's earnings print. So shareholder losses, we just discussed, increased slightly to 780 million, but this came despite 26% increase in vehicle sales, 9% increase in revenue, and 0.3 improvement in gross margin to 10%. So what about the first half? First half, similar story. Losses increased 15.9% year-over-year to 1.7 billion, despite a year-over-year increase in vehicle sales of 30%, revenue increase of 13%, and a 1.1% point increase in gross margin to 9.1%. And this is why I always say just looking at vehicle units sold is completely inadequate, because there are various ways our company can just boost sales and therefore drive up unit sales while there is no net improvement in the underlying economics. And this is very important to understand about NIO. NIO has always put this carrot in front of investors. We grow by 30%, 50%, 80% over so-and-so time frame. But it was all based on price cuts and other things. And that generated chart you're looking at in front of you. So NIO has been loss-making forever. They have never had a profitable quarter. So when you look at these numbers real quick, in 2022, shareholders losses 2 billion. 2023, it increased 3 billion losses, 45% increase. 2024, losses increased further, 3.2 billion in shareholder losses. 2025, thus far, the first half is up almost 16%, 1.7 billion after 2 quarters. But the story doesn't end here. So let's look at NIO's financial resources. In front of you, you see total available cash. This includes everything that we can find on the balance sheet that is liquid, that is cash and cash equivalents, restricted cash, short-term investments. That amounted to just under 3.8 billion as of June. That's a slight increase, a 4% increase quarter over quarter. That increase is driven by NIO raising capital in March, but closing took place in April, and for that reason was after the cut-off date for a balance sheet for the balance sheet of in the first quarter, which is 31st of March. So what we see, the slight increase, is the net effect of NIO's cash burn, less, or I should say, NIO's equity raise less the cash burn in the second quarter, left NIO with a little bit more cash, given that the increase in cash was around about 158 million, but NIO raised $500 million. That was roughly a cash burn of 350 million. But because NIO eliminated all cash flow disclosure, we do not know the details what exactly drove the cash burn. But let's move on. When we talk about cash, we always need to look at debt. NIO's debt balance keeps decreasing, and I believe the reason for that is that it's very difficult for NIO to raise new debt, and that's why NIO's existing debt is just rolling off without replacement. So at the end of second quarter, debt balance reduced to 2.1 billion, and the reason why it's exceptionally difficult for NIO to raise additional capital is not only because it's significantly loss-making in the profit and loss statement, it has negative cash flow, but it's also extremely highly levered, and this is what you see on this slide. This slide shows you the leverage ratio. The leverage ratio exceeds 100%, and the reason is NIO's equity has been fully depleted and is actually at a negative. Just high level, a low leverage ratio is somewhere below 40%. Once you get above roughly 60-65%, you're in high territory. And once you get to the level NIO is right now, you're like in super highly over leveraged. And that's why it's basically impossible for NIO to get from a commercial bank at arm's length any loan or issue a bond. It would be exceedingly difficult. Or I should say it would be exceedingly costly. And in here you see the key drivers of the leverage ratio. So you see in this teal color the equity. You can see how the equity kept dropping. This is driven by negative cash flow. And you can see how in the first quarter of this year, for the first time, NIO's equity dropped below positive. It was reported at negative 38 million. This is quite rare. Globally, right now I can't think of another automaker that has negative equity on the balance sheet. And then NIO did this equity raise. The equity raise increases balance sheet equity, but there was apparently too much negative cash flow and offset the capital raise, which resulted in NIO then reporting even more negative equity as of June in the second quarter of 156 million. And this then drove the leverage ratio to over 100%, because the leverage ratio calculation is debt divided by the sum of debt and equity. And if the equity is negative, it reduces the denominator below the level of debt and therefore over 100%. So this was a quick run through the key financial metrics. In the next step, I will be sharing a deep dive outlook where we look at how key driver average selling prices and other things on a product basis have developed. My second quarter forecast was off by 0.9%. In other words, was highly accurate. So if you haven't subscribed already to my research, I highly recommend you do. With that, thank you very much for listening. See you next one. Bye.